Hello traders, it's John from TradingPricePatterns.com. It's Monday, January 21st, 2008. U.S. markets were closed today, and while the U.S. markets were closed observing the Martin Luther King Jr. holiday, foreign markets crashed, quite simply. It's Monday evening, and we're looking at the Dow Jones futures down about 500 points. So we're expecting a pretty nasty open to tomorrow's trading. However, we could see something of a surprise from the Federal Reserve Tuesday morning if they decide to cut interest rates. We've been talking about this a lot. Whether or not they will do it, we don't know. I mean, we're getting pretty close to a regularly scheduled meeting, so a lot of that is up in the air. A lot of that is speculation. We're going to throw that speculation on the table for a moment and instead focus on what we can measure, what we do know, and that is the market is deeply oversold going into tomorrow's trading, especially if you get a big gap down as indicated by the futures. So let's take a look at a couple of the indicators we're watching and preparing for tomorrow's opening with. First is the Dow Jones Industrial Average. We've been talking about a bearish price objective of 11,800 for several months now, and it looks like tomorrow we will easily get that if the market does gap down, as the futures indicate tonight. Looking at that 11,800 level, it might serve as a short-term catalyst for a technical based rally. Again, market is deeply oversold here. We're looking at one of our very favorite indicators. It's the New York Stock Exchange bullish percent. As of last Friday, we're down to 20%. We expect with the big gap down tomorrow, we should drop down into the teens in this indicator. That's a deeply oversold value, one that sets up the potential for a short-term rally. Also, one of our favorite indicators, the McClellan Oscillator. Last Friday closed right around 44. That's a negative 44 or minus 44. With the big gap down Tuesday morning, we could see this drop all the way down to maybe 80, maybe even down to 100. But if it does get down to 100, we were looking to buy for a trade. That's one indicator and one level to put on your radar. And finally, we have the volatility index, or the VIX. Look, it looks like it's tracing a bullish pennant or a bullish triangle here from which it's about to break out, and it should tomorrow if the market gaps down. Now, the VIX is our measure of fear. Basically, the higher it goes, the more fearful the market is, and more likely it is to reverse higher in the short term. So if we get a move here, maybe closer to 40, if we do see a print at 40, that would certainly lend credence to short-term bullish reversal. Now, all these indicators add up to a pretty good potential for a short-term rally. That is, if the market gaps down. There is the potential, as we mentioned earlier, for the Fed to step in and maybe try to halt the slide in stocks, in which case that changes things quite a bit and may be a little bit more difficult to set up a good bullish trade, at least from a risk and reward perspective. Either way, we've outlined both scenarios on our blog post tonight. If you want to check it out, go to TradingPricePatterns.com. Click on the blog, make sure you do that, and you'll read the scenarios and also get a list of stocks that we're watching as potential bullish candidates